All right. I think we got most people in. Thank you, everybody, for joining us today. For those of you who don't know, my name is Rodrigo Gordillo. I'm the president of Resolve Asset Management Global and also the co-founder and trading advisor for the Return Stacked suite of ETFs. And I'm delighted to have today my co-creator, Corey Hoffstein, CIO of Newfound Research, co-founder of Return Stacked ETFs, portfolio manager of the Return Stacked suite of ETFs as well. Thank you all for joining today. And, if you haven't heard of the Return Stacked suite lineup before, I hope most of you do, but for those that haven't been following, ultimately what this suite of ETFs aims to do is to unlock the benefits of diversification. And this is done by allowing you to introduce alternative investment strategies and exposures to your portfolio without having to sacrifice your core stock and bond exposure, which we're going to address here throughout the presentation. Now, the idea here in the suite of ETFs is that it follows a simple formula. For every dollar that is invested, we're going to provide $1 of either core stock or bond exposure, plus an extra $1 of an alternative asset class or investment strategy. And we launched our first ETF here in February 2023, and this suite has actually surpassed $870 million under assets under management in under 2 years, which obviously means that there's a demand for this type of prepackaged solution. And today I'm actually quite excited to have Corey specifically talk about the new Return Stacked Bonds and Merger Arbitrage ETF. The ticker is RSBA. And he will highlight the ways that one can utilize this ETF and how it fits within everything else that we offer. Now, before I do pass it on to Corey, I want to take a few minutes to walk everybody through the concept a little bit more and why we think the solution is really poised to make waves in the wealth management space and hopefully directly in your clients' portfolios. Importantly, by the way, as we go through all these slides, please do feel free to ask questions along the way. Either Corey or I are going to be checking the chat and trying to answer through chat format. And if we feel like it's something that the group would benefit from, we will make sure to kind of stop each other along the way and ask some questions. So let's get to it. Let's talk about the return stacking problem that we're trying to solve. So look, I've been in the business for about 20 years, and I spent my career trying to convince allocators to make room in portfolios in order to add this much needed diversifying asset. Right? In my case, it's systematic macro and managed futures. And the way this normally looks is I would ask advisors and investors to sell, let's say 10% of their equities, 10% of their bonds, and add enough of a diversifying strategy that it makes a difference, right? So a 20% allocation is generally what I was kind of pushing for. And this was a lot easier back in 2008 when we'd come off of an abysmal period for the 60-40 portfolio, mainly driven by poor equity performance. That those two bear markets in the early 2000s and the credit crisis in 2008. It was a lot easier to say, hey, this is actually performed better. Why don't you add it to your portfolio for diversification? But the reality is that post-COVID, post-credit crisis, those alternatives were overshadowed by a record-breaking bull market in U.S. equities and bonds. And that experience is actually depicted in this slide here, where we can kind of show the impact, both behaviorally and to the portfolio, of making a decision to make room in your portfolio to add 20% of a diversifier. So what this chart actually shows is the relative performance of a 50-30-20 portfolio, where it's 50% stocks, 30% bonds, 20% managed futures, versus the return of a 60-40, just a basic 60-40 portfolio. And when the line's going up, what it means is that the more diversified portfolio is outperforming a basic 60-40 because that 20% allocation is doing better than the rest of the portfolio. And when the line is going down, that gray boxed area and the red line going down is when the diversified portfolio is underperforming the 60-40 portfolio because the alternative is lagging versus a simple 60-40. In other words, managed futures had a fantastic go during the 2000-2010 period, which was very low returns for equities and very good returns for the alternatives. And so selling equities and bonds to make room for this diversifier was fantastic. Investors absolutely loved it. Behaviorally, course they could hold on to something that's doing better, right? But if you were around for the period after that, what happened was, again, this massive bull market in U.S. Stocks and bonds, a perpetual grind up that outperformed nearly everything. And so it's no surprise that alternatives were just not a great addition to the portfolio in that decade. And most people, most advisors really had a really difficult time holding on to something that took a decade of underperformance for something that is cheaper, more transparent. And so this problem, I finally kind of got fed up with it, Corey and I, and we wrote the paper, the return stacking strategies for overcoming a low return environment, to see if we could find a solution to this behavioral problem. And what could investors do in order to have their diversification cake and eat the traditional allocations too? And this is where this next slide is the idea that we wanted to create a fund family that offers prepackaged exposures to both of these things simultaneously, the beta and the systematic macro on top. In other words, the solution here is that we aim to provide exposure to a full dollar to traditional betas and another dollar of a diversifying strategy or asset class on top. In this way, we allow their investors to actually have more capital efficiency in their portfolios. They get to keep their market exposures intact, but also add those much needed diversifying alternatives on top of their traditional portfolio. So packaging, while the packaging in this space is unique from our perspective, this one-to-one approach, this profoundly powerful concept of portable alpha or return stacking is really nothing new. It's been around for over 4 decades, and it's being applied by institutional investors across the world. And that was used back then in order to help both their portfolio diversification and return profile. And so while we may be the first to explicitly make this available to a retail audience in an ETF wrapper in this one-to-one format, let's be clear, it is nothing new. So let's talk about how the solution changes how we should think about asset allocation framework. In this slide here, what we see as the old world approach is what I described, right? This idea of selling equities and bonds to add that 20%. The new world approach is this idea of keeping your stocks and bonds and adding that 20%. And I say this new world approach because it's new world for private wealth. Again, not new for institutions. It has been very useful. Right? So what happens then behaviorally, and what does it look like from a relative performance point of view when instead of making room we add? Well, it's a massive difference here in terms of relative performance and making it behaviorally robust to hold these things. So what we have here now is, instead of the 50-30-20 relative to a 60-40, we now have a 60-40 and 20 relative to a 60-40. And you can see that the relative performance in the 2000s was not as strong as the previous slide because, of course, we didn't sell down the equities that was hurting us during that period, but we still benefited from that 20% diversifier on top. And in the 2010s, when the green line kinks a little bit, we enter that gray area where alternatives broadly underperformed in a period where managed futures exclusively kind of, had low single-digit returns for a while. And stocks and bonds went up to this massive bull market. Even then, you can see that line is upward sloping because in this case, you are, even if it's 1% or 2%, you are stacking those returns on top, and therefore it's an upward drifting equity line. So clearly, there's a behaviorally robust approach to doing this, but let's think about how different allocators think about return stacking. And I think there's 2 ways to think about this, 2 or both, right? The first one is the stacking for outperformance. If we're thoughtful about allocating to valuable alternative sleeves that have historically exhibited 7 to 8 out of 10 positive years and calendar years, then over time, we have an expectation that the 60-40-20, or any stack that you prefer, 20 is just an example, is likely to outperform a 60-40 without having to necessarily focus on security selection in your equities and bonds in order to have some alpha, or tactical asset allocation in order to have some alpha, that ever elusive alpha that becomes much more complicated in the most efficient market in the world, which is the U.S. equity market, right? So we're kind of moving away from security selection and actually moving towards just stacking completely different things on top. And so that can benefit you from just simply trying to do better for clients and your portfolio. And then on the diversification side, obviously we can see how adding non-correlated stacks to your portfolio could allow the benefit of diversification, but importantly, without diluting your stock and bond holding, right? So we get to sidestep many of the behavioral problems of holding onto things in our portfolio that are very different. And one key thing here is not just the behavioral side of performing in line, but the fact that it's prepackaged as a line item in client portfolios, that line item risk that most advisors here, I'm sure, have struggled with through the years, if you allocate it to any alternatives, will be reduced drastically when thinking about it in a prepackaged way. So with that, that's kind of the big picture view of return stacking and why we think it's so valuable. We can open it up for questions here if anybody has anything specific on the return stacking side. But at this point, I'd like to pass on the reins to Corey to discuss specifically the return stack bonds and manage and merger arbitrage ETF. And so, Corey, I'll pass it over to you unless there are any questions that need to be answered.
No questions at the moment, Rod. Thank you for that intro. I'm really excited today to talk about this ETF. This is an ETF that we launched in early to mid-December. I don't think it got the appropriate attention it deserves because of the holiday season. And so we wanted to start the year with a focus and highlight on this ETF. This is a fund that we spent over a year trying to bring to market. One I personally put a lot of blood, sweat, and tears into, and one I'm incredibly excited about the future of, because I think it is such a powerful combination. And I hope that's what you walk away with at the end of today's presentation. Now, before I start, I want to do a quick poll, because as we bring these different combinations to market, we are introducing combinations of traditional betas like stocks and bonds, and then many alternative asset classes and investment strategies. And so what I want to ask with this poll is how many people are actually familiar with merger arbitrage as an investment strategy? We'll give it a minute here while people vote. Choices here are you're unfamiliar, really you've never heard of it. Maybe you're somewhat familiar, it's something you've heard of, you don't really know how it works. You're familiar. Or you're very familiar. You invest in it, you watch M&A activity, you really understand how it works. So give it a minute here as the answers to this poll come in. And actually, I'm going to go ahead while people are still answering, and we can get the results in a minute. So as Rodrigo laid out, the basic idea of our suite is that for every dollar you invest, we're going to give you a prepackaged dollar of a portable alpha concept. In the case of RSBA, our bonds and merger arbitrage ETF, when you give us $1, we're going to give you $1 of U.S. Treasury exposure plus $1 of a merger arbitrage strategy. So 100% exposure of every dollar goes into U.S. Treasuries, and then we're going to add on top, again, this whole return stacking concept, a merger arbitrage strategy. And before we go into the details of the merger arbitrage strategy, we want to talk about why we chose merger arbitrage as another alternative investment strategy to stack on top. And it's because we think it provides a really interesting, potentially diversifying return stream compared to traditional assets that investors tend to allocate to. So what we have shown on this screen is the comparative returns of U.S. Treasuries in the blue line, U.S. corporate bonds in the black line, and a merger arbitrage index, one that trades pretty much every M&A deal in the US in the tealish green line. And what I want to highlight here is that compared to US Treasuries, there's almost zero correlation between US Treasuries and merger arbitrage. And then there's only around a 0.3 correlation between the traditional merger arb strategy and US corporate bonds. What also makes merger arbitrage appealing, in my opinion, is that it has a really strong theoretical foundation as a risk premium. And I'm going to go into that a little bit in the following slides when we dive into merger arbitrage and how our particular strategy works and how we implement it. But the basic idea here is when you're getting paid for an alternative strategy, there's really two things you could be getting paid for. You're getting paid for a risk premium in which you are warehousing some form of risk in the market and you're expecting to get paid for it. And it's hard for that to be arbitraged away necessarily versus you're taking advantage of investor misbehavior, and that's more likely to get arbitraged away. And so what I personally really like is when we can find alternative risk premia that investors may not have access to that we can give them access to. And so being a risk premia, it's not too much of a surprise that merger arbitrage has exhibited positive long-term returns over its history. It's exhibited low correlation to stocks and bonds. But what I think is particularly compelling about merger arbitrage is that it's significantly outperformed the credit risk premium, both in total return and during large US equity drawdowns. So what we have on this slide is major drawdown periods over the last 15 years. You got the 2008 credit crisis, you have March 2020, you have the 2021-2022 inflation spike. And what you can see is in those periods where you have large US equity drawdowns in that dark, blackish, midnight blue type color, you have in the light blue how the credit premium did. Now, I want to pause here and explain. What we're isolating here with the credit premium is the return of corporate bonds minus the return of the tenor matching US Treasuries. So in other words, we're really isolating the credit component, not the return of what the underlying duration did, which would include sort of the Treasury component, but just the credit component. And you can see that in 2008, which was a credit crisis, credit did quite poorly. Credit did quite poorly in 2020, and then credit didn't do particularly well in 2021, 2022. Now, you'll see that merger arbitrage in the teal there did also have losses in all those periods, right? I want to stress this is not totally uncorrelated to equities. There is a risk premium here that is tied to what's going on in the overall market. As you can imagine, merger and arbitrage activity is somewhat pro-cyclical, but we can see that the losses tend to be substantially less than credit risk has historically been. And so that's pretty interesting when you think about, again, stacking something on top of bonds. So in this slide, what we've done is we've isolated those premia specifically. In the black line, we've isolated the credit risk premium and its return since 2006. In the teal line, we've isolated the merger risk premium and its return since 2006. And then on the right, we have a correlation matrix. And what we can see is that both merger and credit premium do have some correlation to US stocks. Merger premium somewhere around a 0.55, credit premium around 0.65. I wouldn't read too much into that, right? These are statistical numbers. They're clouded in some uncertainty. So those are pretty similar. Both uncorrelated to US Treasuries, lowly correlated. But importantly here, what I want to highlight is that 0.45 correlation between the merger premium and the credit premium, right? So these are not the same risk premia. And so I think there's a compelling argument here for folks who are potentially looking for a diversifier to credit risk to look towards the merger risk premium. And so when we take merger arbitrage and we stack it on top of Treasuries, it is very similar to thinking about taking the credit risk premium and stacking it on top of Treasuries, which is effectively how you get corporate bonds. So what we have in this slide in the blue line is US Treasuries. In the darker black line, we have US corporate bonds. The teal line is merger arbitrage. And then that gray background mountain chart is what happens if you take US Treasuries and stack merger arbitrage on top. I think what you'll see is that there's going to be a correlation, right, to what happens with US Treasuries, of course, but a correlation to what happens with corporates as well, because they both share that US Treasury component, but it's tapping into a different risk premium that you're layering on top. So when we're talking about adding a total return stream to our portfolio, we can look towards credit as one option. I think merger arbitrage is just as, if not more, of a compelling option to stack on top of our bonds if we're trying to layer something on our portfolio. But I think what we can see here is this is potentially a great diversifier to existing corporate bond exposure. If we're looking for growth in our portfolio and we're trying to stretch for some yield rather than looking towards corporate bonds, we might actually say, let's not go out the credit risk curve where we might not get paid. Let's think about keeping that bond exposure and stacking on a different risk premium that we have high conviction in could return something positive. So how do we actually do this in the portfolio? Well, let's start with just how do we implement the bond strategy. This is the very vanilla part. Our intention with the return stacked ETF suite is to make sure that we're giving you very basic, plain vanilla beta exposure as the base stack of the portfolio. So here, where we just want to give you a diversified ladder of US Treasuries, what we do is instead of buying the underlying Treasury bonds, we are going to hold the entire portfolio effectively in cash, T-bills or cash alternatives, money market funds, hold a small slice as our collateral and use that collateral to buy a ladder of 2, 5, 10, and long bond US Treasury futures. And we're going to equal weight those. So for every dollar you give us, we're going to put $1 in T-bills, and then we're going to buy 25 cents of 2-year, 5-year, 10-year, and US long bond Treasury futures. And that exposure gives you something that looks pretty similar to what a diversified US Treasury portfolio would look like. And then what we've effectively done is freed up that cash to implement our merger arbitrage strategy, which requires us buying the underlying companies. And I'll get into that in a second. So I want to pause real quickly. Did we get the answer to the poll, Rodrigo? It's still showing up as not being finished on my side.
Yeah, I didn't see it. Ani, please let us know. There it is. Okay.
There we go. Great. So it looks like about 50% of people are unfamiliar or somewhat familiar, and the other 50% are familiar or very familiar. So for those of us who are very familiar, please pardon me while I spend an extra minute here walking through the basics of what merger arbitrage is, and then we'll get into the details. But it's great to see that, for the most part, people have some familiarity with this strategy. So what is merger arbitrage? So merger arbitrage is a strategy that deals with investing in those companies that they are already involved in an announced merger and acquisition deal. And typically what it involves is capturing the spread between the current price that a target company is trading at versus the price that the deal is announcing that they will be purchased at. For all cash deals, it simply requires buying the company. For cash plus stock deals, you typically buy the company and short the acquiring company. Now, these sorts of strategies typically focus on those publicly announced mergers that are legally binding, though there are some implementations that might search, obviously, for M&A pre-announcement opportunities. But for the most part, when we're talking about M&A, these are post-announcement opportunities. And I want to highlight, particularly in the US, those legally binding opportunities are very, very hard to get out of. I would urge you to think about what happened with Elon Musk trying to buy Twitter. Simply his announcement of his offer forced his hand into purchasing that company because these announcements are so hard to get out of. So there's a long-standing tradition of corporate law in the US that makes M&A announcements very, very difficult to get out of. So it makes it an interesting trading opportunity, because what happens is after a stock, a target company, there's an announcement of an intended deal. An acquirer announces they're going to buy a target for a certain price. You tend to see the price of that target company jump up. But it doesn't always jump fully up to the target price at which the deal is going to go through. Why? Well, there's a couple of reasons why, which we'll get to in the next slide. But this difference in where the stock is trading and the actual target price of the acquisition represents what we would call a deal spread. This is the amount of spread return that is possible to be earned if the deal actually goes through. And then you can think of the price where it's trading at versus the pre-announcement price as the potential expected loss. If the company, if the deal falls through for whatever reason, and deals can fall through, you can think of regulatory intervention, for example, as being a reason why a deal might fall through. That company that's being targeted is likely to fall back to that pre-announcement price, adjusted for market drift. Now, what goes into this deal spread? Why does it not trade all the way up to the target price? Well, the first reason is the time value of money, right? If I say I'm acquiring a company for $50, but that acquisition isn't going to happen for a year, well, then the price, if there's 100% certainty that deal is going to go through, should basically be $50 discounted by the 1-year zero coupon bond rate. There's just a time value of money. So it shouldn't perfectly equal the deal price until the moment the deal is closed. So that actually introduces a little bit of complexity, right? Because you don't always know how long these deals are going to take. And so there might be a little bit of term premium embedded in there. If the deal takes a little bit longer than expected, there might be some inflation premium embedded in there. And then there's other deal risks. You can sort of think of these a little bit like a credit risk. There's regulatory approval that could block a deal or make a deal take a lot longer than expected. There's shareholder composition risks. Who actually is the deciding factor as to whether this deal can go through or not? There's valuation and financing risks. There's a whole bunch of different deal risks that come together that can take what should just be a time value of money problem and increase that spread to be larger and larger. And these uncertainties represent risk factors, and that's why we tend to think of merger arbitrage as a risk premium. When you are buying these companies after the announcement, but prior to the deal being closed, you are warehousing the risk that the deal falls through, and your compensation for warehousing that risk is you're going to earn the rest of that spread. And so we expect there to be a spread above short-term rates as compensation for bearing that risk, as well as compensation for just the opportunity cost of your money. So that's generic merger arbitrage. The question then is, how do we implement it in our portfolio? Because a complete beta approach to this would be we just buy every single announced deal in some sort of market cap weighted fashion or in some sort of equal weight fashion. There's a variety of ways you could do this, but it's worth considering that there are some deals for which there might be very little juice to squeeze and some deals for which you get overcompensated for the credit risk. If you think the market is pricing perhaps the risk of a deal falling through as being far higher than it really is, you might say, actually, there's a lot of risk premium there to be earned that I think the market is pricing as being too wide, and I want to own that. And so what we ended up doing was sourcing a manager, a firm called Alpha Beta, who'd been running a merger arbitrage strategy in their hedge fund book for the last several years, and getting them to extract that actively managed strategy and turn it into an index. And so our merger arbitrage strategy tracks the Alpha Beta merger arbitrage index, or seeks to track it. Now, what does that index seek to achieve, and how does it work? Well, the index seeks to generate an annualized return of U.S. Treasury bills plus 400 basis points annualized. Does not mean every year. Obviously, the opportunity set of M&A activity will change over time, particularly based on the regulatory environment and the market cycle. But over a full market cycle, that is the intended return that it's trying to generate, which means it needs to be selective about the deals it's adding. I want to point out here, when we talk about adding bonds plus merger arbitrage, right, we are inherently using leverage. And the cost of our leverage in the portfolio tends to come out at about the US Treasury bill rate. We've written a lot about this in articles. I don't want to go into too much detail, but when people ask us about what's the expected return in this portfolio, what I tend to say is, if the merger arbitrage index is seeking to hit Treasury bills plus 400 basis points, and the base is just US Treasuries, diversified US Treasuries, we would then say we are seeking to hit, over the long run, US Treasuries plus 400 basis points. That's how the math is going to work out, and that's ultimately what this portfolio is targeting over a full market cycle. So what is the actual investment criteria? How does this merger arbitrage strategy work to try to meet that objective? Well, first and foremost, it's only going to be trading US listed deals. And it's only going to be US listed deals that are going to meet certain expected return and expected probability of closing thresholds, right? If we take every single deal, the reality is merger arbitrage is historically a strategy that would give you 200, 250 basis points of annualized return. To get it to the 400, we have to be more selective about the deals we're taking. We can't just take deals that are giving us the time value money. We need to make sure we're focusing on deals that actually have a risk premium associated. And so what this strategy is going to do is it's going to be selective about the deals, and it's only going to allow up to 20 deals to be in the portfolio at any given time. Those deal weights are going to be dynamically managed and adjusted based on the return, the expected return, and the expected risk, as well as the liquidity available for that deal. And this strategy is unique in that it allows up to 200% leverage. So I'll go through precisely sort of some portfolio construction and go through an example in a minute, but I think those pieces are really, really important. When we talk about how much M&A activity there is every year, there are hundreds and hundreds of deals. People have often looked at the last couple of years and said it's been a very light M&A activity environment. In the last 5 years, there have been over 200 deals per year on average. So there's still a lot of activity that happens. This index is going to be very selective in the deals in which it goes into at any given time, focusing on those 20 deals that have the highest expected return. And if they're all very attractive, it's going to allow the portfolio weight of those deals to drift up to 200% exposure. So let's talk about the actual portfolio construction. Merger arbitrage is an event-driven strategy, and so the index is going to rebalance on an event-driven basis. What this means is anytime a new deal is announced, in the background, every deal is going to get sorted by its risk-adjusted return. Well, not just when a deal is announced. Deal is announced, a deal is canceled, or a deal is completed. Basically, anytime there's finalized activity in the index, every deal that is still existing is going to get sorted based upon its expected return. The expected return being what's the probability the deal gets completed times the deal spread that's left, minus what's the probability the deal falls apart, minus that how far the deal could fall. And it's going to screen deals to make sure that they pass certain expected return criteria, the probability of completion is high enough, and that they're liquid enough. We're focused mostly on large cap and mid cap deals. As deals get smaller and smaller to that small cap threshold, it's harder to put money into them. And so they can be allowed, but the size in which they're allowed in the portfolio is much smaller. Each deal is initially given a starting weight of 12.5%, and then they're formulaically adjusted upward and downward based on the current deal risk and liquidity constraints. If a new deal violates adding above the 20, the worst returning potential deal is taken out. And if there are sufficiently attractive deals, again, we could have 20 deals up to a total leverage of 200%. So let's go through an example of how this sort of works with a single deal. I won't say what company this was. This is just a hypothetical example, but what you can see here is in late November 2023, this company had a deal that was announced. That's step one. And what you can see is the price immediately jumped. The target price of acquisition of this company was $45. On the right-hand side of this graph, we have the portfolio weight that would have been in the index. And the gray line is what that weight is. The black line is the price that the company is trading at prior to the deal being closed. So step one, a deal is announced and a position is initiated. And what we can see is, I said before, every deal starts with a weight of 12.5%. The weight was immediately cut down to 6% because the deal jumped so high relative to the target price. It started at about $25, jumped north of $40 when the target price is $45. So there was only so much juice to squeeze here. Now, what's interesting is over time, as the price sort of was stagnant, if not drifted a little lower, this was a period where the market actually went up. And so that deal spread remained static, if not got a little bigger, but the risk to the downside went down because that initial price adjusted for market movement actually went up. So if the deal fell apart, there wasn't as far to fall. And so the deal became a little bit more attractive. The S&P, positive return of the S&P reduced the downside risk of the deal. And you can see the weight actually went up from about 6 to 8%. And then as the price started to go back up from 40 to 42.5, the deal got less attractive. The deal got cut in size. And then over time, again, we see, not shown here with the S&P movement, but at 0.4, this is a time where price went from 42.5, fell down to below 40. The S&P was having still positive returns over this period. So the deal premium versus risk of the deal falling apart became much more attractive. The expected return became much more attractive. And so you can see the price, the weight moving all the way up from 6% up to 10%. Before that final rally where it became clear the deal was going to get complete, you see price move up towards the 45 target very rapidly. And that's where we cut our position and then eventually would have taken it out of the index. So this is a very dynamic process. Constantly, as deals are being added to the universe, canceled, every time something happens with a deal, the weights are all reevaluated to evaluate the potential expected return of the deal, taking into account the probability of completion, that deal spread, the probability it's being canceled, and that downside risk. So how do we think about, taking a big step back, how do we think about using RSBA in a portfolio, right? Again, what you're getting when you invest in RSBA as an ETF is when you invest $1, you're getting $1 of US Treasuries plus $1 of this merger arbitrage strategy. And so going back to some of the original slides that Rodrigo talked about, the opportunity here is to be able to retain your core bond exposure, but stack merger arbitrage on top of your portfolio as an additional return stream, right? So on the left side here, we have your traditional 60-40, 60% stocks, 40% bond portfolio. If you replace, say, 20% of your bonds with RSBA, and you do an X-ray through that portfolio, really what you're getting is 60% stocks, 40% bonds. You get your bonds back, plus the excess returns of that merger arbitrage strategy. Similarly, if you replace all your bonds with RSBA, 60% stocks, 40% RSBA, and you do an X-ray through that, you would get 60% of your stocks back, 40% of your bonds, and 40% of this merger arbitrage strategy. Again, I think what's compelling here is to think about this either as, for growth clients, an additional risk premium you would add on top of their portfolio. I think that's one really attractive use. I think the other really attractive use is for the intermediate term liquidity bucket, where you can say to someone who's got that 10 to 12 year investment horizon, we can sort of duration match your liability using the underlying treasuries, and then try to add a return spread on top of that using merger arbitrage. I think that's very attractive for an intermediate liquidity bucket. And I think it's very attractive as an alternative or a diversifier to traditional corporate bonds. If you have traditional corporate bonds in your portfolio, and I see this a ton with sort of 80-20 clients, those growth clients tend to be 80% stocks, 20% corporate bonds. I think RSBA makes a tremendous diversifier or replacement for corporate bonds. So sort of final slide here, and then I'll open it up for questions. But again, as a core review of RSBA, this is a strategy that's seeking long-term capital appreciation through the combination of two strategies. Every dollar you put into this ETF, it's going to seek to provide you $1 of core US Treasury exposure plus $1 of merger arbitrage strategy exposure. Again, those US Treasuries, we're going to give you an equal weight ladder of 2, 5, 10, and long bond US Treasury exposure. The merger arbitrage strategy seeks to track the alpha beta merger arbitrage index, which is an index that takes a strong security selection approach to merger arbitrage to try to hit an objective of a return of T-bills plus 400 basis points over time. This is a strategy that's going to rebalance on an event-driven basis, always trying to match that dollar for dollar. And then one of the questions we get quite frequently is, if this is meant to be a corporate bond alternative, how often are we making distributions? This ETF is meant to make distributions annually. This is meant to be, again, there's no real distributions coming out of merger arbitrage. This is a total return vehicle. And again, why we think it's really appropriate in that growth seeking outperformance type category, use of return stacking or portable alpha. With that, Rodrigo, I will open it up for any questions.
Perfect. That was great, Corey. Thank you for the explanation. Yeah, we do have a few questions. Why don't we start here with, we talked a lot about return stacking. Let's talk a second about our expectations in terms of risk comps versus corporate bonds. We're stacking 100% of something else on top of treasuries. Have you done any analysis on what the prepackaged solution does versus a corporate bond in terms of volatility, annualized standard deviation?
Yeah, so I think what's important when you think about a corporate bond is where we say we're giving you US Treasuries plus 100% of a strategy of merger arbitrage, corporate bonds are US Treasuries plus 100% to a credit risk premium, right? And I think what you see here, again, what we've in green is a merger arbitrage index, a generic merger arbitrage index, the excess returns. In black is the excess returns of the credit risk premium. I think you can sort of eyeball that and say, ignoring 2008, these things actually have pretty similar volatility. When you look at merger arbitrage as a strategy, it tends, depending on the implementation, tends to have a vol between sort of 4 and 7%, right? And if you look at, and again, these are hard and fast numbers, but you look at the black line versus the gray line, ignore the fact that the gray line is higher than the black line for a moment, and you just sort of mentally overlay them. You can see there's not a huge amount of difference in the vol there, and nor is there a huge amount of difference to the vol in U.S. Treasuries. They are higher vol, but again, because you're stacking things on top of U.S. Treasuries, whether it's the credit risk premium or the merger arbitrage premium that are uncorrelated to Treasuries, you're not just adding their volatility together. You're getting to benefit from the diversification and the low correlation. I think what's really critical here, we'll go back to this example, is when a deal is announced, right, it jumps, and then the vol of that stock tends to die. So when you look at this stock, again, an unnamed hypothetical example, but this company, right, deal was announced at 45, the stock price had jumped from 25 to about 41, and then that stock price stayed in the 41 to 40 to 45 zone for 7+ months, right? The volatility of this stuff tends to dampen dramatically. And then you talk about diversifying across 15, 20 names, and you can imagine the vol of a merger arb strategy can actually be quite low. And so I actually think comparatively, the vol of Treasuries plus merger arb looks very similar to the vol of total market corporate bonds.
Yeah, and when you look at one of the questions was, what is the vol? And if the vol of corporate bonds, I think the last time I saw it is something between 8 and 9% annualized standard deviation. That's kind of what our expectation will be for the RSBA stack, I think, as well. So yeah, that's a great answer, Corey. Thank you for that. A couple other questions here. What happens if the stock price goes above the deal price because investors think the offer will get bumped up, or is that usually only before the offer is accepted?
So it'd be very unusual for the stock price to go above the deal price. In that case, for us, what would happen, right? What we're really, what the strategy is doing is it is going to be looking at the expected return of all these deals. Right. So anytime a deal is announced, canceled, added to the universe, we're going to rescreen all the deals. And the expected return is the probability of the deals getting completed. We can talk about how that actually, I totally sort of ignored how that is calculated or how we estimate it. Right. But the probability it gets completed times the deal spread minus the probability of cancellation times the expected loss. The deal spread is always based on the target price. And so if the price goes above the target price, all of that becomes negative by definition. And so the expected return becomes negative. It's a little bit of a weird outlier. It is possible that, we would, as it approaches, if it was in the universe, as it approaches that deal price, we would be dramatically cutting the weight, likely taking it out of the universe at a certain point. But then if the target gets bumped back up to a higher target, it's possible it gets added back in.
So on that note, one of the questions is the alpha beta index decision purely systematic, or is there some discretionary component to it?
No, it is systematically managed. Alpha beta is a quantitative firm, and they systematically manage the index.
Question on tax. So what do we expect taxes to look like here? It's an ETF. A lot of people have this view of the tax efficiency of ETFs. What are your thoughts on that?
Yeah, so this is one of the reasons we designed it the way we did, was in an effort to be as tax efficient as we could make it, right? So there's one implementation of this strategy where you buy the underlying treasuries and then you get access to all these individual deals synthetically, right? You're trading swaps with banks, or you're trading options if you have them to create synthetic futures. That would be a very tax inefficient implementation, right? You would get ordinary income from all the treasuries, and then you're not getting great taxes when you're employing derivatives to create the merger arbitrage exposure. We did it in reverse, right? And so US Treasury futures are taxed on a 60-40 basis, 60% long-term cap gains, 40% short-term cap gains. Those Treasury futures are rolled quarterly though. So you're not going to get taxed on the coupon income and ordinary income. You're going to get a better tax rate, but you're going to get taxed on gains and losses that happen. Obviously not taxed on losses, but you get credit for the losses within the fund if there are losses on the bonds that get realized as we roll those futures. So there are some studies that show that Treasury futures are a more tax efficient way to implement Treasury exposure, but I would say it's path dependent and potentially a wash. But by freeing up all that cash, we can then buy the underlying stocks and then hopefully use the create redeem mechanism of the ETF vehicle over time to manage the cost basis of those stocks to try to avoid taxes. I won't say avoid taxes, try to minimize the realized capital gains that investors should have to pay for that strategy.
Okay, let's chat a little bit about correlation. There's a few questions here. What is the expected correlation between merger arbitrage, stocks and equities, but also the rest of our suite? So trend, carry, and anything else that we might be thinking about launching.
Yeah. So again, I think there's the question of what does merger arbitrage look like versus what does bonds plus merger arbitrage look like? I think this slide shows merger as a premium, just sort of as a general risk premium, does have a decent correlation of stocks, right? It's sort of like the credit premium. There's a pro-cyclicality to it, not only in M&A activity, but again, in a massive economic recession, deals do have the potential to fall through, and there's less deal activity. So there is somewhat of a correlation there. It's obviously not perfectly one. Historically, the drawdowns have been significantly not less correlated, but less severe than the credit premium. So we prefer the merger premium versus the credit premium, but there is some correlation of stocks. Very uncorrelated to treasuries. So again, we think that makes it appealing to stack on top of treasuries, and very uncorrelated to managed futures and carry. And so as a third stack that we're bringing to the market, that's something we're explicitly looking for, is stacks that are uncorrelated to our existing stacks. And I would tend to think of this one as being a little bit more in that category of stacking for outperformance rather than stacking for diversification. I don't think this is the sort of stack that's going to be particularly compelling during a recession, but I think if you're swapping or diversifying your corporate bonds for this strategy, right, I do think it can be compelling as a diversifier to what you already have.
Yeah, I think the numbers I saw on the correlation for trend and carry is close to zero for merger arbitrage. So definitely one of the reasons why we launched it as a great diversifier to our diversifiers. So let's move on to talked about correlation. We're being asked, just kind of broadly speaking, how does this merger arbitrage implementation compare to other merger arbitrage funds in the market today?
Yeah.
Any thoughts on that? I mean, there's a lot to talk about there, but
yeah. So I'll say there's sort of two styles of funds in the market today. Well, three styles of funds, if I'm being fair. The first is just broad market access, right? And so there's these merger arbitrage funds that will trade every single deal, and you can think of that as merger arbitrage beta, and that's totally fine, totally valid. Again, I think it gives you about a 250 basis point premium on top of T-bills. I think that can be attractive and compelling, but that's just sort of the generic beta. You then have the other category of what I would call the discretionary managers. These are folks that are looking at every single deal, combing through the legal documents, and trying to find market mispricing on a discretionary basis. And then you have the ones that are purely quantitative, like us. And as you can imagine, name the biggest quantitative firms. There's about 4 or 5 of them that do quantitative merger arbitrage. And the real difference, I want to go back to this slide, because I think this summarizes a lot of the thinking, which is when we look at a deal, what is the expected return, right? The folks who are doing just broad beta, they don't care, right? It's sort of like when you buy every stock in the investment universe, you're just buying every stock. The people who are doing the discretionary approach are trying to figure out, right, this probability of completion. That's what's really key here, because the deal spread or the expected loss, those are just sort of given by the market. We know what the target price is. We know what it's trading at now. The deal spread is given to us. We can sort of have different models of the expected loss depending on how we're adjusting for market beta and industry beta and all that sort of stuff. But by and large, those numbers shouldn't be too different. So what view could possibly be different? The answer is how you're computing this idea of what's the probability of a deal being completed. And discretionary managers often have lawyers on staff that are going through all the deals, and they're looking at the fundamentals of the acquiring company. They're looking at the company getting acquired. They're trying to figure out whether there's going to be regulatory issues or not. They are coming at that from a soft approach. I don't mean soft in a demeaning manner. It's just a soft sciences approach. Whereas a quant firm is going to develop a model. So Alpha Beta, for example, what they've done is they've looked at every single deal, announced deal in U.S. merger arbitrage history going back to 2010. Going back to 1999. And then once they had 10 years of data, they started training a machine learning model, taking into account things like how the deal is structured, the quality of the acquirer, what deal type it is, what sort of industry concentration are we talking about, different signals of regulatory risk. And they use that machine learning model to train whether sort of an estimate of deal completion based on the prior 10 years of deals. You might ask, well, how many deals does that cover? Here's an example. In the early 2000s, you were talking about having more than 250 deals a year. So if you take, everything from 1999 to 2010, you're talking about thousands of deals over which they're training on, right? And then they're using that model and constantly retraining it over time to include new deals to estimate, looking at a current deal, looking at all these numerical characteristics of the deal, putting it into the machine learning model, what probability between 0 and 100% comes out. And that's how a quant firm is going to approach merger arbitrage. Probability a deal gets canceled, by the way, is just 1 minus the probability that a deal gets completed, right? Those have to sum up to 100. So once you have one of those numbers, the other one falls out naturally, and the whole expected return can be calculated. But the big difference between the quant firms and the discretionary firms is the quant firms are obviously going to try to model this using some sort of computer model, right? Taking all these quantitative and any soft inputs, they're going to try to turn into hard inputs and build a model around it, whereas the discretionary managers are going to approach it all through a soft lens.
Yeah, and there's also a few that are taking all the deals rather than trying to be they're trying to provide just a pure exposure to the factor, which ends up, becoming very efficient and providing very little compared to T-bills. And this is a much more concentrated and focused approach, 20 deals at any given time. So that's another big major difference there. And Thomas asked a question that I think should have been answered by what you just said with regard to what we're predominantly targeting in a specific spread. As Corey alluded to, it's a multivariate approach that allows us to put our positions in the proper sizing. One last review question before we leave you be, Corey. Just can you go back to slide 16 where we're looking at the relative performance during market duress? Yeah, so we're asking about, we talked about volatility and expected volatility. The next question was, what can we expect in terms of max drawdown during the worst bear markets? And this is just kind of indicative of the space. You can see that the correlation is still positive a little bit. So as Corey alluded to earlier, merger arbitrage does go down, but significantly less so than the credit risk. So pretty good.
And I think what's interesting to point out here, right, is if you're doing merger arbitrage on top of U.S. Treasuries, right, you basically are adding the blue bar and the teal bar. If you're doing U.S. corporate bonds, right, you're basically taking U.S. Treasuries and adding credit. So in 2008, merger arbitrage plus U.S. Treasuries, given these two bars, would probably get you somewhere around flat, right? And then credit plus U.S. Treasuries would have been negative, right? And so when we look at this chart, it's no surprise to see a drawdown in US in corporate. There's no surprise to see a bit of a drawdown in merger arb, but over the full period, you do sort of get those two things canceling out. And because merger arbitrage has historically exhibited less of a drawdown than credit, right? Going back to that corporate law that makes it so very hard for companies to get out of these deals. A company can default on a bond pretty easily. It's very hard for a company to get out of an announced merger without them going bankrupt or regulators intervening, right? Again, I would urge people to think about Elon Musk buying Twitter, now at X. He was effectively forced into that deal because of the strength of corporate law in the US around announced mergers. And that's what allows it to have a lower drawdown profile. It still has the correlation to equities in a drawdown, but doesn't have as severe a profile as credit risk usually does.
Yeah, I think that's the key takeaway here as we leave. I think, this idea of, well, what are you buying when you buy a corporate bond? You're buying two elements here, right? You're buying the treasury and you're buying some sort of risk premium. And you have this massive equity exposure. Most portfolios do very strong equity exposure already. We see from the data that Corey has provided to us that while the correlation is high for merger arbitrage, the drawdowns are significantly lower. So if you're going to stack a risk premium on top that is independent of treasuries and somewhat independent of equities, this is a viable option that I think is probably a bit more compelling. But in terms of, is it a crisis alpha stack? No. It is more likely to be a similar type of profile as a corporate bond portfolio, just trying to stack returns rather than offset massive risk in the bear market. Okay, that we answered every single question, Corey. So
on time this time.
Well done. Okay, well, thank you everybody for joining us today. If you do have any questions, please go to our website at returnstackedetfs.com. This presentation is on the RSBA site. You will be able to kind of review everything we talked about slide by slide. If you have any questions that you want to ask our team directly, go to the contact us section or email at info@thinknewfound.com. If you go to the contact us section of the website, you will be able to find your territory within the US or globally and speak with the right representative on our team. We thank you very much for taking the time out of your day to learn a bit more about our products, and we look forward to having you back in the coming webinars that we have planned. Thank you, Corey.
Thank you.